you're still very bullish on precious metals, gold and silver. It
Hmm.
seems that gold has broken out now, has it? Do you think we're on to something?
I think we've only got one number left. We've had multiple buy triggers since the
Uh,
pullback low last summer and fall. As they turned back up, we issued buy signals as different indicators broke through. Our first major buy on gold was 1,700. It was about $75 off of its reaction low. And as far as we're concerned, gold's got all the green lights. Now, there's price charts you can look at and say, well, let's go make a new high. Okay, fine, fine. But
yeah,
I'm talking from a momentum perspective.
sure.
Silver has one level left for it. It's already triggered many of our buy signals. And that's like, I'll tell you how high it is. It starts about 50 cents above today's high. And
Hmm.
the next final number is about $1.50 above today's high.
Hmm.
That if you ever see like the upper, like 24.95 area again, and that's in the middle of the past couple year range after all. So it doesn't
Hmm.
look important. But to us, it says, that's it, gone. You're going to take off.
Hmm.
Silver's going to suddenly come out of this mishmash
Yeah.
and get a backbone real quick. So we like the monetary metals. The commodity markets are very interesting because they peaked shortly within about a week after the Ukraine-Russia war began. Okay, so that war didn't cause their boom. The boom in commodities started in October 2020 and extended to February 2022. And basically peaked then. If you look at crude oil or the Bloomberg Commodity Index, most markets peaked in early 2022. Again, about coincident with the war. So the war didn't cause it. The war, in fact, stopped the rally. Okay.
Hmm.
Since then, you've had a corrective process in almost every commodity. And don't link silver and gold to this. They have a different breathing pattern.
Sure.
They doubled in price while commodities were still at lows. But anyway, that Bloomberg Commodity Index and crude oil as well, which looks important right now. I don't think it's going to lead the commodity complex in the next up, but I think it'll be a contributor. They both look like it wouldn't take a heck of a lot in percent terms. I'm talking 4 or 5%, for example, of an upturn from where you are now, where they'll re-engage the longer term uptrend that started in late 2020 and has had a correction since, not a bear market, but a corrective decline. We think that next leg could start, probably it's going to start soon, despite the fact that the Fed has been raising rates.
Hmm.
That the effect of the rate rise is to punch a hole in their bubble. Commodities aren't a bubble.
Right. Right.
Bloomberg Commodity Index is like 103 right now. Heck, it was well up in the high 200s back in 2008 through 2011. So it's hardly a bubble.
Yeah.
It's only been going up for a year and a half or 2 years also. So it's not a bubble in that regard. So we think that when the Fed finally has to loosen on the rate policy, that the stimulus isn't going into the stock market this time because investor preferences have shifted. It's going to go into commodities again.
Right. Right.
And so I think Stockman's right. There's
Yeah.
probably more quote inflation to come if you want to narrowly define it as commodity type inflation. Yeah.
Right.
Yeah, the miners have definitely underperformed gold over the last 2 years, as gold has gone mostly sideways with one brief dip. Silver has corrected in a parallel downtrend channel, and the miners have come down a large percent. They don't even look like they're related to gold, but they've moved down with gold while gold went sideways to down. They will snap back more than will gold, and will outperform gold, probably during much of what's left on the upside. And we think there's a lot left on the upside in terms of price, in terms of gold and silver. We think the miners at this point are basically at a slingshot low level relative to gold, so they'll snap, catch up to gold on a percentage basis, and likely outperform it.
Hmm.
And that's their behavior pattern over the decades, by the
Yeah.
way.
Well, if interest rates are going up, then it doesn't allow a lot of the speculation that took place in the equity markets and in the tech sector. That, I mean, people could get a free ride and they could try any stupid idea they wanted. There was no repercussions until now. And now Mother Nature is paying a visit, and it's not going to be kind to people that have been irresponsible. Of course, the irresponsibility starts with the Fed and the government that pumps money in the system and tries to buy votes or whatever it does with the money. The equities, so the air that still needs to come out, equities and debt markets, I guess.
No, I think the T-bond market, the long end of the federal the debt market, let's say 10 years on out especially,
Yes.
probably saw its low, meaning it's high in rates. Okay, long end I'm talking. We hit a target level back in October that we had predefined as a likely strong bounce point. We didn't think necessarily it'd be the low, but it would be a point at which you'd rally strongly. Sure enough, you did. And now on reassessment, we tend to think that you probably have seen about the worst you're going to see on the downside in the T-bond prices, buys and yields. That if you look at a T-bond market and compare it to the stock market, the T-bond market had a massive bear market. They took the bond prices back down to about 2009 levels. Be like the S&P trading under 1,000, okay? Look at TLT, for example, the long-term government debt ETF. It wiped out 20 years of upside in the last couple of years. So it paid its dues. And I think that smart money, scared money, once they realize that the stock market is not bottoming here, but is rolling over again, is going to have to go to the traditional safe place, which is T-bonds, which have not been safe last year, but I think they are now, and gold and silver. They're not going to rival gold, but I think it will be a, quote, safe place to be. Fed announced in the summer of 2021 they were going to start raising rates. They started raising rates in 2022. Okay, so let's take the close of 2021, 1820s on gold. Oh, okay, here's an interesting price chart. Normally we focus on momentum, but since everybody's focused on price, we wanted to show something important here. By the way, that last rectangle there, these are monthly bars of gold going back to the year 2008 here. The last bull market top in 2011 and 12 looked very similar to what we did up prior to last summer when we broke through the bottom of the box. Everybody thought, oh gosh, it's a replica of what happened in 2013, namely gold's crash, we're going into a bear market finally. We argued based on momentum, which we're not showing here, that when that breakout occurred on price that it would be a bear trap. In other words, it would not sustain. It went 3.5% below that lower line of that lower end of the box. 3.5%, got to a low at 1613. And within a couple of months, we're back up pushing the highs of the range again. Get the 1959 in January. And if you look at the monthly closes there, that almost matched the two prior high monthly closes. So price chart was very misleading. But if you the close of 2021 and the close of 2022 are right above 1800, about 1820. So gold last year had a net zero year, no losses, unchanged on the year. Compare that to other major assets. Gold was saying something. Why wasn't it going down if the Fed was raising rates aggressively last year? Why was the stock market and bonds going down and so forth? Why not gold, right? It makes sense, but it didn't. Why not? Maybe it knew something was coming with the banks. We'll find out soon. Anyway, the point of these charts here is to show that if you're fixated on price charts, be cautious. Make sure that momentum is agreeing with what price is telling you. Otherwise, price could be very deceptive, which it was in that case. We picked three, we call them the big three, Microsoft, Amazon, and Apple. And in February of last year, January, February. In January, we went bearish on Amazon. Same time we went bearish on the NASDAQ 100. And it had a big drop. Bearish on Apple and Microsoft in February's close of last year. Again, 2022 we're talking, way back a couple of months off the highs. At that point, Apple was $166. It dropped down to the low 120s. It's the worst it did. Far better in terms of less downside than Microsoft and Amazon or the NASDAQ 100. So among the big three, it was the outstanding one that said, oh, look at me, I'm hanging in there. What does that mean? It means a lot of investors will gravitate toward that which is not sinking as much as others. So it's perceived like the banks were a couple months ago as a safe place to be because it's doing better than others. We got up over 160 now in this rally. So Apple's coming back up toward the price level where we said it was a bear, and we still think it's a bear. We're looking at it as shorter term technicals, and we think that if it sneezes, like dropbacks much below 155, for example, this rally's probably over and it's going to rejoin. Now, the reason Apple's important is that if you take the better performing sectors Right now, that would have been banks, which is no longer the case, ambush there. Healthcare is one I'd watch. Very well performing sector, just gone sideways for the last 2 years, not down. I think that's very vulnerable to a sharp down.
Yeah.
That will surprise people. And among the big tech stocks, Apple's the one that everybody's bet that, oh, thank goodness, if Apple's behaving well, everything's okay, right?
Yeah.
Well, if you upset them with Apple, like you upset them with the banks, then what does that do to hope?
No.
It goes out the window.
Not much
oh
left.
gosh, there's no place to hide.
Not much left, yeah.
That's when you get your sentiment shift. It's when the good ones don't behave good anymore.